Well, what can the Nifty 50 and tech bubble teach us about today's market? Very important. Listen to this. Every market cycle has a story. In the early 70s, it was the Nifty 50. In the late 1990s, it was the internet and technology boom. Today, it's artificial intelligence, AI. The late 1990s, we saw the technology boom where the internet was revolutionary innovation that truly changed the world. Investors were correct about the technology, but wrong. I'm saying wrong about what they should pay for it. Very important what you pay for something. Companies with little revenue and no profits traded at astronomical valuations. The NASDAQ saw a five-fold increase between 1995 and 2000. I did not play that game.
Yeah, and I think the interesting thing there was we haven't seen that type of appreciation in a 5-year period, but this period has been extrapolated out over a longer time frame.
Right.
So that's a concern I have. Is like, yeah, we haven't seen a five-fold increase in the last 5 years, but I mean, we haven't really had a major decline that's been sustained since the financial crisis.
Yeah.
But what we look at is when the bubble burst from the tech bubble, the fallout was severe. And again, I brought this number up, but it is so important for you to understand. The NASDAQ ultimately lost almost 80% of its value. So you're riding this wave right now of like, oh, I made so much money. Imagine losing 80% in the NASDAQ. That would crush so many investors. And hundreds of companies in that time period disappeared. Even industry leaders such as Cisco, Intel, and Microsoft, they experienced stock declines of 50 to 90%. Many investors assumed technology would continue growing forever and overlooked the simple fact that stock prices had already discounted years of future success. And I love this point too. After peaking in March 2000, it took over 15 years for the NASDAQ to reclaim its previous high in April 2015. That now means if we were to peak out right now on the NASDAQ and you had to wait 15 years, you're in 2041.
Right.
If you're 65 retiring, you can't wait 15 years for recovery. You will run out of money.
I was going to use 70. If you're 70, you're going to miss out on travel, everything else, because you'll hit 85, hopefully you make it, before you break even. So that means during that time frame, you can't travel, you can't do stuff, maybe you can't buy a new car. You can't be so risky as you get older because it's something that's very concerning. And again, I always want to remind people, yeah, I'm doing great, I'm up 100%. It only takes a 50% decline to put you back to where you started at. So it doesn't take a 100% decline. Half of that, 50%, you're back to where you started, made no money at all. As you mentioned, sometimes down 60, 70, 80%.
Yeah, I mean, you could more than wipe out your 100% gain.
Yeah. So oftentimes I do hear people say this time, oh, here we go again. This time is different because unlike many internet companies in 2000, today's AI leaders are highly profitable businesses generating enormous cash flow. So let's take a look at the Nifty 50 as another, maybe more similar example.
In the Nifty 50 era, it was built around the belief that a small group of dominant companies were so good that valuation no longer mattered. Does that sound familiar? Maybe magnificent, if we will. But investors, they piled into stocks such as Coca-Cola, IBM, Xerox, Polaroid, McDonald's. I love this one, Sears, and others. These companies were viewed as one decision stocks. Buy them and never sell them. Investors would make excuses for the valuations because the businesses were strong. Through 1972, these firms averaged 22% annual earnings growth over the previous 5-year period, and they had great profitability with an average return on equity over 22%. The problem was as enthusiasm grew, valuations expanded dramatically, with many trading at 40 to 60 times earnings, despite an economy growing much slower.
Well, then reality arrived. The 73, 74 bear market combined with inflation, rising interest rates, and economic recession caused many of the stocks to fall 50 to 80%. Just imagine that. The S&P 500 fell over 14% in 1973 and more than 26% in 1974. Most of those companies survived and remained successful businesses, but investors who paid excessive prices often waited a decade or longer to earn satisfactory returns. You've got to know what you're paying for something. Doesn't mean you'll be right tomorrow, but 3, 4, 5, 10 years road makes a big difference on your portfolio.
Yeah, and I just really love the Nifty 50 example because I'm just so tired of hearing, oh, it's different than the .com because these are great businesses. And the Nifty 50 points out the prime example of a great business at a way too expensive price. And I believe that's where we are now. A lot of these companies are great companies. They're just too expensive.
Yeah.
And I think the Nifty 50 draws in a lot of those parallels. And what we look at here is today's AI boom. It has similarities to both those periods, as I said. Like the Nifty 50, investors are concentrating heavily in a small number of dominant companies. And like the tech bubble, there's widespread excitement surrounding a transformational technology that is likely to reshape entire industries. And there's no denying that. I mean, AI is here to stay, but again, is the hype too strong?
And also, too, you think about the railroads. You think about television, radio. These are all major things, too, technology-wise, more railroads, but still that.
Talk about energy is now in the shale boom.
Oh, yeah. I mean, it happens all the time, and the ending is always the same. However, history reminds us that even great companies can become poor investments when expectations become too optimistic. During every major market cycle, investors eventually discover the difference between a great business and a great stock. The key lesson from both the Nifty 50 and the dot-com era is that transformative technologies often live up to their promise. What investors frequently get wrong is the price they are willing to pay for the future growth.
And AI may ultimately be every bit as revolutionary as investors believe. The bigger question, though, is whether today's stock prices already reflect much of that future success. As we've learned from previous cycles, when expectations become too high, excellent results may not be enough to satisfy the market. And I do believe that's where we are / where we could still be heading.
Yeah, and we're learning as kids the fable of the tortoise and the hare. You're the hare if you're investing now. You're like, oh yeah, I'm way far ahead. It's not a big deal. I'm gonna make more money. No, I'm sorry. That's why there's those fables that tell you don't do crazy stuff.
And one thing that I wanted to point out that we didn't have in the newsletter or this information was when I look at the semiconductor exposure.
Right.
Semiconductors, again, are a very volatile, very cyclical industry. Semiconductors now make up around 20% in the S&P and about 40% of the NASDAQ based off the numbers I saw. I said it's up 80% so far year to date. How much more growth can that cyclical industry have? And the problem is we've seen semiconductors before. In 2022, they crashed tremendously, but they weren't that large part of the market. Now being close to, I'm going to say half of the NASDAQ, I mean, you have a 50% decline. That is very hard to offset that in the NASDAQ.
Right.
And that's my concern with the semiconductor space as well, is like it's just putting so much risk in the market. And, people are riding it higher. They're enjoying the ride. But, I guess we'll continue to be what's the phrase? The wet blanket in the room.
Yeah, that's fine. And because, again, you're out there, another phrase, like you're at the party, you're drunk, everything's great, and you leave, you fall, you get an accident. I mean, that's what's going to happen. You got to realize what you're doing. Patience does pay off. But when you get so excited and so blinded by, oh, I'm up 20, 30, 40, 50%, I know what I'm doing. I heard about financial advisors doing very well before he did that. He was a blue-collar worker. But now, because he bought all these tech companies, oh, he's so smart. We'll see. He probably doesn't have a long career.
I got to say this, too. When you be very careful buying value ETFs, value mutual funds. There's a lot of them out there. I had this gentleman call the other day. He's like, well, you're not outperforming this value ETF. I looked at it, top holdings, NVIDIA, Microsoft, AMD. And I was like, this is not a value fund.
Right.
And there's a lot of people claiming value, I think, trying to take that namesake, but use the high returns that, yeah, we're the best value fund out there. And I think there's a lot of risk that people, again, need to be aware of.
That's an important part you bring up is know what you're investing into. Speaking of that,